Hello, everyone. Welcome to another fabulous episode of the Free Money Podcast, the only podcast in the entire world. On this episode, we've got CalSTRS Head of Sustainable Investment and Stewardship Strategies, Kristy Jenkinson, and she's talking to us about all sorts of great stuff. We can exclusively break here that she just bought her first house in the United States, which is really cool. You'll hear more about that later. But we talk about what it means as a practical matter to make a net zero commitment by 2050 at a place like CalSTRS that's been a vocal advocate of ESG since 2004. They're also planning to escalate their level of shareholder engagement. What does that mean as a practical matter? And then we talk about, they're ramping up private investments with an eye towards climate solutions and thinking particularly about stuff like affordable housing as part of that, which I would say is, kind of squarely outside of a lot of people's kind of gut assumptions about what those investment opportunities might target. After that, as always, we talk about various hard things that we're encountering and our various attempts to build things. And then we answer questions from you in the Dear Ashby segment that everyone knows and loves. This time we talk about what our seed starting setups look like, Ashby's experience with the Russian Sovereign Wealth Fund, and assuming governance and disclosure are managed properly, what proportion of a long-term investment portfolio should be invested in private assets? And then if you stick around through all that till the end, you'll get our gold, good garden tip. If you want to skip straight to the interview, go ahead and jump to 18 minutes in. If not, settle in for another hour of wonderful free money. But first, it's time for Sharkbait, the disclosure pirate. Take it away.
Ahoy, Free Money Podcast listeners! I'm Sharkbait Buckley, the disclosure pirate, and I'm here to set ye straight about what's going on with this here show. Sloan Ortel works for Invest Vegan LLC, a New York registered investment advisor. Ashby Monk works for Stanford University, Adapar, Future Proof, Long Game, and various startups. All opinions expressed by either Sloan or Ashby are entirely their own, and do not reflect the opinions of their crew or any company. Clients who Invest Vegan may maintain positions in securities and strategies discussed in this podcast. Advisory services are only offered to clients or prospective clients where Invest Vegan and its representatives are properly licensed or exempted, and a client agreement has been executed. Arr!
Here comes the money.
Here we go. Money talk.
Here comes the money. Money.
Welcome to the Free Money Podcast, where we bring you the Brooklyn Bay Area consensus about institutional investing that you desperately crave.
Yo,
Woo.
this.
Woo!
I have an opening statement too. This is the podcast where we free money from the shekels of short-termism and empower the world's investors to meet their needs while also meeting the needs of us all. We also work diligently to get other people to pay for our own gardens in the form of carbon offset technology.
Yeah, it's a real, it's sort of, what you might call a social enterprise.
You might call it that. We also try accents from around the world and butcher them.
I mean, yes, by we, definitely that's all of us. We all do that.
Everybody in the show is encouraged to just try on accents. I don't think people realize that we mean the free money. Like, we're out there looking for deals for you, and that we should have more, just more opportunities for people to get free stuff.
That's a great point. I realized I was like looking into weird merch ideas a couple nights ago, and it turns out you can get custom Crocs charms. Are you a Crocs user?
I think I've had a pair of Crocs in my life. Not recently. Are you rocking Crocs right now?
I picked up a Bunyan early in the a couple of months ago, I guess in the middle of the winter, and the Crocs were my way out of it. And now they're pretty much my only shoe. And now that COVID is going away, I'm like having to face the reality that I may someday have to go to an event that I cannot wear Crocs to.
I love how you're like, I picked up a Bunyan It gives it a vibe like this was, you know, you had a choice of matter. It's like, yeah, I picked up a root canal on the way.
My feet decided to like let me down, basically, is what really happened.
Oh my gosh. So anyway, so our commitment here, listeners, we're going to find lots of good stuff for you. That's why you're here.
Yep.
But before we get into the news, I have to say, Sloan, I've been solo parenting. Oh yeah. I've been solo parenting. So people are back out there traveling, including my spouse, Spicy.
Your spice, the spice of your life.
The spice. She'll be like, why do you call me Spice? She'll be like, I just happened live. Yeah. So
Yeah, Wife Spice, or Courtney Spice, the
Courtney Spice,
the Spice Woman
band. She was one of the Spice sisters. What were they called?
Spice Women.
What was the band called?
They're the Spice Girls. They're
Spice Girls. Oh my god! I was like, literally, I forgot it was the Spice Girls. Anyway, solo parenting. I find this is just my little tip because it's been 2 years since anybody's traveled. It's a little bit easier. I'm not saying that my kids haven't had pizza 3 nights in a row. They have, but it's a little bit easier because I think the threats work better when kids are older. Anyway, there's a tip out there. Threats, you know, you're like, I am going to take your phone away. It's not hard for me to do. And they're like, it wouldn't be that hard. You know, you can see it in it. You know, you're like, that phone is there, then I'll have it. And then you won't have it. And
you're still small. You're big, but you're smaller than me, and I can put this on a high shelf. And you won't be able to reach it.
It'll go somewhere you won't find it, and then I'll have it. So anyway, here we are Friday. I'm glad Courtney comes back tomorrow, so it'll be good. Anywho,
you'll be liberated from or at least, you know, kind of joined in the threat making enterprise.
We're very good at threats together. We're joined up. I've got some good news here. Are you ready for some news?
I mean, I feel like we could use some of that.
Yeah. Well, here is some good news then. Pension funds, according to the firm Willis Towers Watson, which is the
mega consultant.
It's a mega consultant. They do pension fund consulting, so they should know what I'm about to tell you. And they're telling me and you, Sloan, that pension funds, as of now, have $57 trillion in assets, which is why we study them so hard. These organizations, you know, we talk about the asset owner community having, you know, more than 100 trillion, but just in pension funds now are 57 trillion. So to me, that kind of is a reminder of how important these organizations are in the world. And I'm always shocked that as few people study them as do.
You know, I think that one of the things, a corollary to that, is that the people who do study them are so often just like alarmist, you know, and not really like, you know, the type of people who engage with like the underlying realities. Like we've talked about this book that I bought off the internet a while ago called Pension Fund Socialism, that's written by Peter Drucker, of all people.
Oh, yeah. He's quite good.
You know,
he's a good author, that Peter Drucker.
He's a great, I mean, he's like one of the management scholars of our generation, but he's like, you know, a pretty right-wing guy. And in the 80s, he was like, you know, these pension funds are gaining a lot of power. And if they get good at listening to their constituents and implementing responsible investing, it could ruin the economic system that we have that's built on extraction and shareholder prominence.
He was right.
But it's I mean,
except for the ruined part. But the fact that the pension funds could have a huge influence, correct. Ruin?
No, but the straight line from the straight line from could to will.
Yeah.
I think where you and I would beg to differ with them.
I love that you're calling out the Drucker. He is actually quite influential between right and left leaning folks, because he started to capture the fact that that pension funds have this huge role. And Gordon Clark wrote a book probably about 2 decades after pension fund socialism called Pension Fund Capitalism. And pension fund capitalism kind of paints the portrait, and that's more constructive, of a principal layer in the capitalist system that is actually taking the long term seriously and not just being extractive. And I think it was that book, not the socialism, but the capitalism around pension funds, that kind of sent me on the trajectory that I am today, and realizing, you know what, if we get how these funds invest right, you can really fix capitalism.
Yeah, and Gordon Clark, of course, being not just the author of a good book, but also your PhD thesis advisor.
True, and co-authored a number of books with me. Yes. This is the self-promotion part of the story.
Yes, yeah.
Right.
I mean, yeah,
the
go buy
on
socialism book.
Yeah, I'll be like, hey, go buy all of Gordon's books, and then they'll
yeah.
Then I'll get a free cup of coffee.
Hell yeah!
All right, next story.
Free money for Ashby.
Free money. We're on after it. Next story comes to us from Abu Dhabi, and it relates to the Abu Dhabi Investment Authority, which some people believe is maybe, we don't know because they're secretive, maybe the biggest sovereign fund on earth. And this is a quote. ADIA has cut dozens of jobs over the past year as part of a 272 million cost-saving program. And I think this is good news and bad news for people that want to work at sovereign wealth funds. The good news is, boys, though, some people are making a lot of money managing sovereign wealth, dozens of jobs equaling up to 272 billion. That's a lot.
Yeah, that's pretty good average comp.
Yeah. So that's the good news. The bad news is these specific jobs are gone. So you're not going to get any of those jobs that were clearly high paying. But, it struck me that like the asset owner community used to be notorious for underpaying talent and kind of relying on affinity and 9-to-5 work weeks, for recruiting talent. And now we're into a space where 24 people could make, almost 300 million bucks. Fine. 36 people make 300 million bucks. Like, it's crazy that if we're going to take it on face value, I'm sure there's some nuance I'm missing here, but I didn't do the research.
I mean, like, why would anyone do that? I mean, it like, unless the Saudis are being really sneaky and like, dozens, of course, dozens means like 8 dozen.
The Emirates. The Emiratis.
Oh, yes.
Not the Saudis.
The Emiratis. Wow. Yeah.
All good.
Yeah, very good. Very good job, Sloan. But yeah, like, unless they're being very secretive, usually you see these asset owners making the opposite mistake, right? Where, it's like not enough people, not enough comp, right? And, and then the fees wind up being indirect, right. In the form of like, stuff charged by consultants, stuff charged by asset managers. I guess at least if they're overpaying people, they can do it in-house. That's great.
I love it. Yeah. So it's almost like we've been doing this podcast together for a few years because you sound like me, which is you're paying it anyway to somebody. Like somebody's charging you to invest your money. And so if you're paying it internally, at least you can see where it's going. And maybe you even keep the money in your community. And now people, are driving around in nicer cars and they're, planting beautiful trees and whatnot. But if you aren't paying it internally, then you're going to pay it externally, or you're going to have to change your expected return target, which nobody wants to do. So yeah, I agree with you. I think it's interesting to see this level of compensation kind of becoming more normal. We all knew that like organizations like GIC were paying incredibly well in Singapore. There's been great pay in the Canadian funds for 20, 30 years. And now in the Middle East, it's clearly there. I'm guessing some of this are the expat roles that are being cut in part because the domestic population is now ready to step into those roles, which was always a challenge. I remember when I first went to Abu Dhabi, I looked at the wall of one of the sovereign funds. I think it was the council, and it had pictures of sand dunes with Mustangs on the car. And I was looking at it. It was like, that's here where I'm standing. And what was so shocking is it wasn't like 100 years ago, this was a sand dune. It was like when Mustangs existed, which was like 60s and 70s. This
Yep.
whole place was a sand dune. So you think about how much like development has occurred and like the fact that they've got to fill all these jobs. Anyway, you get it.
Yeah. Yeah, I mean, well, it's like I think a lot of people forget that Singapore was not an industrial country at all, right? Like that, and like I mean, a lot can change in 60 years.
True.
If you have if you have a sweet sovereign fund backing up your internal upskilling plan.
It's true. Last bit of news before we get to the break. University of Virginia Investment Management Corporation, UVMCO for sure, says it's going to go net zero 2050, which is fabulous. And it will, this is the bit that's the news, it will be releasing a detailed net zero plan in 2022. Now, I read the initial tentative plan. It's very high level, again, which we've been calling out for a while. But I love that they've made a commitment to release the detailed plan this year because too few of these plans have been published. And the ones that have been published have not been detailed. So it'll be very interesting to see what UVMCO says it's going to do to get its portfolio to net zero.
Yeah, like there's so many different approaches that you could take on that, right? Like, because I mean, obviously, there's just like the dimension of emissions that's like a big deal here. But as you think about emissions across the entire a diversified portfolio, there's a whole bunch of tweaks and tips that you can do that you can make, right? Like some folks are investing in housing, which I know we have a guest lined up who's going to talk to us a little bit about.
Oh,
not to tease that too much before she shows up, but but yeah, you have everything from like investing in housing to just like funding clean tech and carbon sequestration solutions to question mark using the ingenuity of the investment community to try and like move some capital towards solutions.
For sure. I mean, look, I think with the net zero portfolios here, like we got to measure, we got to trace, we got to track, and then we got to offset. And I don't really think I've seen an asset owner detail just how they're going to do all that. Like,
yeah,
the measurement part's going to be very hard. Then the decision on how you like offset what you're not going to get to net zero with, is it avoidance? Is it, you're pulling carbon out of the air? So a lot of this stuff. Yeah. Anyway, this is going to happen among many, many, many clans. And so it's almost as if this is like a catalyst for change, which is why I'm so interested in it, that will take place across thousands of investment organizations, large ones.
Yeah, I mean, like, I think that, we probably need to, flagellate ourselves a little bit for the amount of crap that we've been giving to this whole net zero 2050 movement, because, I mean, it is, if nothing else, a rallying point for people to talk about.
Does flagellate mean self-congratulate?
I mean,
hit yourself.
It means hit yourself.
That's what I thought.
I mean, like for a certain kind of person, I think that could be a congratulatory gesture.
I saw the Da Vinci Code. So that was one. Yeah.
That was exactly what I was thinking of.
Really? Yeah, that seemed pretty brutal.
Yep. Yeah. The for those who, are not up on, the literary classics and, the associated film media, we're talking about a member of a Catholic sect called Opus Dei that, wears a nice, I guess, a barbed wire garter. Cuts into his leg. And periodically hits himself with a leather cat o' nine tails.
Now available in the Free Money Podcast Atelier.
Maybe what I should do is like, just source one of these very rare items that we come up with and like auction it off for charity, so we could get, the official Free Money cat o' nine tails.
We don't even need that. What we need to do is create an NFT where somebody owns the moment where we created the idea of the garter money, whatever, self-flagellation toolkit. We don't even need to make it the real world. We just created an NFT.
That's a great point.
That's the beauty of the NFTs. You don't actually have to do anything.
You know, that is a fascinating, innovative financing model, Ashby. I can see.
That's what I do. Yeah, I think
Yep.
creatively about how to, finance important projects, and this is one, and so I feel
Well,
like,
funnily enough, we've got somebody in the waiting room who also
Finally.
thinks, critically about how to finance important projects. And her name is Kristy Jenkinson. She is the head of sustainable investment and stewardship strategies at CalSTRS, which is the California State Teachers Retirement Service or System. I'm not sure.
System. Yeah, no, that's good. You don't want to look up that and do too much research ahead of time. So it is definitely.
Well, 45 minutes. Okay, I'll see you in a minute. Hello,
Kristy.
Oh, 45 minutes. We got you. I heard it.
No, you know what? You won't believe this, but we've just bought our first house in the US.
Oh, good. We got you.
And my husband was just yelling up at me saying, we need to be there at 10:15. I was like, yeah, it's fine.
Yeah. We'll get you out of here in
That's
30 minutes or
fine.
less. I promise.
So I'm so sorry that you heard me yelling to him. He was like,
Oh.
That is so on brand for this podcast.
Oh, yeah.
Have guests screaming at people off camera.
Yeah, we haven't had any technical difficulties, which is fabulous.
Well, this is incredible. I can't believe it. I'm in a like a whole studio. I feel like this is very cool.
Oh, yeah, that's great. Because now the listeners will know just how much technology we bring, because we don't often let on how good we are
Yeah.
at this.
No. Well, I was listening to a couple of you ones, and so I now heard I've heard your voice before. Actually, but slow, and I was like, okay, now I know what voice
Awesome.
it's out for. So I've got a little bit of background research, so I hope I'm going to do all right.
You're going to do
The fact
awesome.
that you have listened to this podcast and still agreed to come on it is, I think, a really good sign.
I think we've worked our game slot. We pretty profesh. Kirsty, we brought you.
That's true.
I'm about to say,
Oh, sorry. I think there's the delay that we were always expecting would happen. But I'll keep talking while I'm talking. So, Kirsty, we brought you on because we want to hear all about the work you're doing at CalSTRS. And one of the things we've been talking at length on this podcast about are the 2050 pledges to get to net zero. In fact, the very last story in our news segment was how University of Virginia just made a commitment to publish their detailed plan in 2022. So it's not just their 2050 commitment, but they promise they're going to get us the detailed plan here. And I know that this is a big part of your work at CalSTRS. You guys have been big advocates of ESG since 2004, way ahead of a lot of other organizations. And so for you, what does the net zero commitment mean in terms of like practical realities at CalSTRS?
gosh, a lot of practical realities. And kind of the first thing is it does sound slightly ironic. You're like, well, we're going to do this by 2050, and everybody, rightly so, whether it's us or whether it's a government or whether it's a city or a mayor, it's like, yeah, really interesting, but what are you doing right now and how are you going to work back? So I think the first thing is we've been really clear that it's the direction of travel. And when you set the direction of travel, it helps you work back from the direction of travel about what you need to do to get there. And so honestly, I think the biggest kind of practical reality is what's the level of change that needs to happen within a very large, complex organization like ours and an investment branch that you need to start doing as of today, yesterday, and 3 weeks ago to enable you to kind of set each foot in front of one another, because you're going to be walking a different path for the next kind of, 20, 30 years. So let me break that down into sort of what does it mean practically? To me, we've tried to put it through this lens of it's going to change and alter the way we think about risk. It's going to change and alter the way we think about investment opportunity. And it's going to change and alter the way that we think about how we use our influence and how we collaborate with the market, because we can manage risk and opportunity within the CalSTRS sort of, headquarters, let's call it the branch that we all sit in. But if we're all going to get to net zero, it doesn't matter what we do within our portfolio. It's actually what happens in the broader universe. And so there's that elements of, influence and collaboration. So happy to walk through more details on each of those, but it's such a fundamental shift about all that we are that you have so much sort of change required.
I want to double click on one, which is the change the way you think about risk. We don't need to spend half an hour talking about the weirdness of risk inside these organizations and how it often emerges out of like Chicago School of Economics and rational market, all this kind of weirdness, right? But one of the ways we talk about ESG at the Future of Finance Council is calling it pre-financial risk. And so when you're thinking about net zero and climate, like how does it become risk inside of CalSTRS?
Well, it's down here again. You can look at it in the conventional way, I suppose, and I say conventional because it's the last couple of years conventional around the physical and the transition risks. And so it's right. We are an operator and an owner of real assets and real buildings. How will the effects of the climate change the risks, not only physically to their being, but also to the costs to run those sort of entities? So that's the tangible bits, which I think we can all wrap our heads around.
Yeah.
The transition piece is obviously way more challenging because that's around, well, what does it mean for the price of the things that I pay that it might be changing as a result of policy and other technological shifts? And we don't have, I think, as a general industry, a great handle on that. So we do at least have this framing of how do you break it down, but then it's really different what risks means for a public equity strategy and a passive equity strategy versus an active equity strategy versus a real estate versus a private equity versus an infrastructure. And so one of the things I've been most fascinated by, but also most troubled by, is how on earth do we then decompose climate risk into each of the specific asset classes in a meaningful way, but then also have a way of reaggregating that risk up to a total fund perspective, because at the end of the day, we've also got to manage and run and think about risk at a total fund level. So it's really, that's the complexity, but also the curiosity that kind of just keeps me fascinated.
And I mean, I imagine that, there's like, when you think about an organization the size of CalSTRS, hundreds of billions of dollars, tens of thousands of beneficiaries. Like, when I'm doing like carbon transition stuff, I can just be like, I'm vegan. I like vegan stocks and I want to buy these ones. But like, there's, I would imagine a multi-year messaging part, project with the community that depends on you guys. That's a core part of this. Is that right?
Yeah, that's a really good point to me, because you touch on again the complexity of this topic versus perhaps more what I would call a traditional financial topic. Is like we don't have to, with our sort of the teachers that we serve, when we talk to them about, interest rates moving, as we know they just have, or whatever else, it doesn't really kind of bring up any other dimensions for them other than, what does this mean for my mortgage? But when you talk about climate change and when you talk about the environment, my goodness, it unleashes a whole host of kind of emotions and thoughts and impacts for them personally, but also about how they think and how they manage their money. And so trying to distinguish the role that we play to manage the investments and do that well versus all the other kind of factors that are influencing us and our behaviors and our emotions around climate is really complicated. And it's made more challenging. Here we are in California, where the physical risks of climate are impacting a lot of our constituencies on a very regular basis. And we're all living through wildfires and smoke. And so, again, I think we have to spend, and we are trying to get more focused on this, is how do we differentiate the actual investment decisions that we need to make from the more understandably emotional links that come with tackling climate change as well. And that's hard. One point I will add as well, can I make, I'm sorry, waffle too much, is around, back to my analogy with interest rates, is the thing I find hard about climate risk is we have a market infrastructure built to help us manage sort of interest rate rises. We know what the signals should be. We know to watch the minutes of the FOMC committee, which will then give us an indication that this is where the market should be heading. Therefore, we can start to price in the fact that, we could be seeing a change in inflation, and therefore that means interest rates will be affected. We don't have that same architecture for climate risk right now. We don't know, I think, as a big institutional investor, how to read the signals most appropriately to then say, well, what's that going to mean to the portfolio? And so that, to me, is one of the things that we will hopefully, as a market, get better at doing. Does that make sense?
Oh my gosh. So much sense is being made by you that I want to like get our t-shirt like machine out and write it onto t-shirts.
Never had that before.
Yeah. Well, like part of me is like this, I keep telling people that we actually don't know how to price climate risk in dollar terms yet, that like many organizations, and I'm curious, I mean, this is off script a little bit, but like, a lot of pension funds I know, like when you think about physical climate risk, they have like red, yellow, and green like categories that like when you talk to like the real estate investment teams, they're like, I don't know what to do with that. Like, what do I do with red? I would know if you told me what it was going to do to my insurance contract to buy this Napa real estate, because of the forest
Yeah.
fire, like I would price that into my decision making. But yellow, what do I do with yellow as a climate risk? So anyway, I'm just curious
Yeah.
if you guys have gotten beyond the red, yellow, green labels of climate risk and into actual dollars and cents.
Well, yeah, and on specifically on real estate, and I'll give a real shout out to a group that we've worked on with this Rhodium Group, another sort of California-based, I guess, research and analysis organization I've got the highest respect for, who I think have done a really good job at trying to sort of say, okay, this is what climate risk looks like in a sort of physical location. But for a real estate portfolio, they've helped us look at some of our properties to do this. They've sort of said, well, what this means is it could require, it's insurance premiums that'll go up. It's the cost of the heating or the cooling that you're going to be requiring to keep that building at a certain, temperature. And it's that, again, we haven't been able to do it for our entire portfolio. So as with often these things, it's a coverage issue as well as a kind of an ability to get the data and how to read it. But I think I'm seeing really interesting, signs that that's changing. And with groups like Rhodium, who come with this sort of real understanding of climate, but who are trying to partner in a way that makes it economically, and gives us the sort of like the price signal, I think that's hugely transformative. And I hope we're just on the cusp of seeing more of those kind of collaborations and kind of initiatives. And then ultimately you do it for a couple of properties, or you do it for a couple of areas. And as we all understand this and they get more sort of, broader, we can expand it to then our entire real estate portfolio. But we're not there yet. But that's the goal that I think we're all working towards.
I mean, I would imagine that is, is not just a risk mitigation tool. It's also an alpha generation tool, right? Like, across the public landscape, there's a significant correlation between sustainability performance and stock performance.
Yeah, absolutely. 100%.
Yeah. So you could control your costs, by adding insulation, by doing all sorts of other stuff. That's a very sort of high engagement form of active management.
Yes, that's a good way of putting it.
Yeah. So talk to me about I guess there's a spectrum there, right? From you have your, you have your real estate portfolio, you get the analytics, you decide to put insulation in them to save on energy costs. To the more indirect holdings that are either intermediated through an asset manager or a public. How are you? I mean, you're in all of it. How are you thinking about that spectrum and allocating your time and analytical resources?
Yeah, it's all about prioritization, I think, and trying to make the right decisions and set the right priorities. And I suppose, again, back to sort of made the pledge to net zero, kind of what we've been working on a lot right now across all of the asset classes is just where should we spend the most time up front? Where is it easiest to get started? Where is it easiest to have the greatest impact, so that it doesn't seem like this overwhelming task that we can't handle, effectively? So it's very much around, okay, so where are our most significant relationships, and should we work with those partners first? Where are our biggest exposures to what we think where climate risk is going to affect us, and the transition to a net zero will be most impactful? Let's work on that area. So it's trying not to do everything immediately. It's trying to be sort of thoughtful around where can we have the single biggest impact in each area, and start with that and go deeper and realize that it's not going to be perfect to start with. That's uncomfortable for everybody. But it's better to be imperfect and get started than to continue to delay.
Yeah, it makes a lot of sense.
One of the,
I don't think we've got all that sorted.
One of our questions that we were going to ask you here is around engagement versus divestment. And I just noted that the state of California might obligate you to divest from fossil fuels. Up until now, how have you guys navigated this engagement and divestment conundrum that is so pervasive?
It's very pervasive, and it's very acute for us as a fund, because we have a very there's a lot of people who come to our board meetings, and every board meeting asks that we divest from fossil fuels. So we see it very sort of firsthand. People are always asking us to divest from fossil fuels, as they believe that, and I understand their point perspective, is a way to tackle climate change. I mean, I'll say personally, and this is an angle that, I think had support across CalSTRS for, is I just don't think it's the right theory of change. I mean, I build it back to okay, we all want to address climate change. That is the piece that I am always really crystal clear whenever I speak to an investment advocate. Is like, let's agree on what we agree on. What I don't agree on is that this is the right way for us to play the influence that I think we have to make the most meaningful contribution. And I say that from two angles. One, I don't think it's the right decision financially for the fund, because I think it's really hard to decide which companies that you want to divest from, and that is always going to be shifting and changing. And I don't think it's right from the climate perspective, because I don't actually think us divesting from fossil fuels is where we can have the greatest impact. I think we should be focusing on other areas that we are, like where can we invest in solutions to climate change? I want my team that I work with to be focusing on investing in solutions at scale, because I think that ultimately is going to have a bigger impact on the climate than CalSTRS spending time deciding and fighting against a divestment. So philosophically, but also practically, I'm personally very opposed to divestment, and I've been very clear about that. Our board actually debated the bill that has just been introduced into the climate legislature just a couple of weeks ago, and also took a majority opposed position. There were a couple of members of our board who are supportive. So again, there isn't complete consensus on this, and I recognize that. But yeah, it's a tough one.
Yeah, because you guys can, I mean, you played a big role in, kind of the engine number one, kind of victory with Exxon, and, certainly like have a significant ability to be like the person who gets those phone calls and catalyzes those changes.
Yeah, I mean, we like to think so. Again, I don't overestimate, there's a lot of investors who are working now on this topic about how do you engage the highest emitters, Climate Action 100 Plus, and a lot of our partners, I do think we're having an impact. I feel really proud about the role that we did play with engine number one, supporting them super early on in Exxon, because I feel like, taking that kind of approach to certain levels of engagement hasn't worked. And when certain levels of engagement don't work, you have to be honest as an investor and say, right, we have to up the ante. And so our support of engine number one was like, we need to go beyond just, a shareholder proposal, and we need to actually change the board. And how can we change the board? Oh, here's an organization who is willing to stage a proxy fight. And so, yeah, we're right behind you. Engine number one from day one. And so that was a perfect confluence of, if you say that you are in favor and you want to support engagement, then it is also incumbent on us to escalate that engagement if the old engagement tactics are not working, and think about other ways to be more effective. And that could be through working as part of a bigger group, so there's more investors, which I think the industry has done super well in the last couple of years to get smarter at working together. Or you ask for something different, which is what we did at Exxon, which is, okay, the change is only going to happen if the board changes. So how do we get the board changed? Well, it's a good idea.
I like talking about the engagement piece, but I think I also naturally get attracted to the climate solutions angle, which is let's go invest in I don't know, well, not like space travel and getting off Earth, but pulling carbon out of the air, and all of the wild clean tech stuff that blew up a decade ago was pretty fun, which is partly why so many people invested in it. And it was a great set of things. Anyway, I'm rambling. But the point is, I know that you guys are starting to make more private investments in climate solutions, and that's part of your strategy. I was wondering if you could just talk a little bit about the climate solutions component of your strategy and how it fits into the portfolio.
Yeah, absolutely. And I'm glad you like talking about it, because it's the one that I just find, again, super fascinating. It's the thing that gets me most excited every day about my job. I just feel like this huge opportunity, that we have to allocate capital in a way that will have a demonstrable positive impact on climate, but also will meet our risk return goals. And I'm 100% confident that because of the way that we've seen, basic economics of shifting policy supports, shifting technology, and shifting consumer preferences, we are in a different world to climate tech 1.0, where a lot of those underlying factors didn't exist. And so the challenges were more acute. I do believe we're in a different world now where there is sufficient deal flow, and there is sufficient deal flow at scale for an investor like CalSTRS to be able to, hit our risk return goals and be able to find the solutions. And so that's what excites me. But you asked practically, what does this mean for the portfolio? Well, the group that I work within, we have a current allocation to public assets. So we manage a public asset portfolio. And one thing that we've been working towards over the last year has been to expand our policy to allow us to invest in private markets across real estate, infrastructure, and private equity. And so we're being quite intentional at saying, okay, we're now going to have a dedicated part of the portfolio that will allow us to do two things, which is again, all part of how it's structured. I think it's, and it sounds, I hope it doesn't sound too in the weeds, but to me, this is so important, is if you're a large pension fund like CalSTRS, it's like, well, how do you start investing in these kinds of solutions? Because there are two challenges. One is a scaling issue, because some of these investment opportunities right now are perhaps not at the size or the scale that we would traditionally look at. So, or my asset class peers in private equity. So how do we allow us to get a sort of toe in the water in a sort of part of the portfolio that might operate at a different sort of smaller level? But as the opportunity grows, you have an opportunity to work with your colleagues in the other asset classes to say, right now it's sort of graduating, it can go into another part of the portfolio over time. So being able to sort of, co-invest as we're doing alongside our private equity colleagues on a couple of deals where they will own half, we'll own half. And over time, we'll hopefully do more and more. And the private equity team is a huge team of assets. My goal and our goal is to do more and be able to scale it. That's really important. But the second piece as well is, I think for an institution like CalSTRS, is we realized there's certain investments in this area that don't fit neatly into one of our traditional buckets. They don't fit neatly into the private equity bucket or the infrastructure bucket. It sits between them. It's a sort of typical betweener. If you don't have a space to be able to invest, then we wouldn't ever invest. So again, our portfolio allows us to do new investments that don't sit nicely in the other asset classes, but which we as CalSTRS should still have exposure to because it's above our actuarial rate of return and it's aligned with what we want to do on climate change. So we've deliberately then allowed ourselves the flexibility to invest in these new opportunities that wouldn't fit elsewhere or are with partners that we haven't traditionally worked with, and allows us just a little bit more, freedom. And again, the method will hopefully be we can prove and do more of that, and then it can scale. And so you've got this sort of trajectory from new opportunities to scaling. And I feel that's the way we have to tackle it.
Do you feel like there's a useful benchmarking tool for what you're doing there? Because it seems like it would be very open to the criticism of where's the beef kind of. For lack of a better word, at a certain point.
Yeah.
And because you're doing this very nuanced things, essentially creating new funding mechanisms for new technologies, it's hard to compare to existing alternatives.
Yeah, and benchmarks been a real question for us. On we've said two things. One, the strategies that we look after, they have to beat the traditional benchmarks because again, this isn't concessionary. We're not doing this as a sort of concessionary finance. That's hopefully in a perfect world, we will be able to collaborate more with, international financial institutions who could provide some of the concessionary capital and we could come in at scale. We're not there yet, but for this portfolio, we have to beat the underlying benchmark. But we also built it in a way that we have a little bit more flexibility for the first few years to allow us to, enable this portfolio to mature over time and then be benchmarked. So the start, we allow ourselves a little bit more flexibility, but ultimately the goal is that it will be benchmarked to the underlying asset class and it has to beat that. So yeah, it's a tough one because to me, you have to beat the underlying benchmark because that's what we're proving and that's what we have to do. But does benchmarking help in this situation? No, because you need some sort of customization. If we're actually going to think about even on our public market portfolio, how do we move towards a low carbon, exposure? Do we need to start to think about how do we customize that benchmark to have more of a low carbon element on it? Because we don't want to be taking too much active risk on that side of things, whilst also decarbonizing. So yeah, the market isn't helping us at this point in some of those areas, if that makes sense.
I want to do a case study of your team. I've just decided in listening to you talk with my Stanford hat on. And part of that comes from this realization that your question, which is how do we start? I think humans have not invented a perpetual motion machine, but the typical public pension plan comes close, just does the same thing forever, right? It's a monopoly, fiduciary duty, prudent person rules, not a lot of incentive to change. And in my experience, the way you change these plans is you reveal crises. And so you use the data and analytics to reveal something about the plan that the stakeholders didn't understand. And then there's a demand to change. And what I've just heard you describe is almost like an R&D unit that is preparing climate solution strategies for the mainstream investment teams that are public equities, private equities, real estate, but that you actually have a dedicated pool of capital where you aren't hamstrung by like, oh, here's our benchmark. Yes, you have to beat the 7.5 or whatever it is, 7.5% return target.
Yep.
Yeah, of course you have to do that. And I think you will. But you have this flexibility to think creatively. And I just want you to know, like, I study this world. That is so rare that you like I can't think of other organizations that have that kind of innovation unit that has a mandate. Am I like, is it really, that's what it is?
Yeah, I mean, what I will say there is I don't want to, it's not just, the change isn't just our unit, the change is the relationship with the underlying asset classes and how we work together.
Okay.
And so to be meaningful, it has to be, and I've done a lot of thinking with our teams have on how do you properly integrate this? Because what I've always said is, I don't want to be the team who sits on the side just doing this that no one actually really cares about, but we're the kind of like defense mechanism for everybody. That's not interesting to me. What's interesting is like, we develop trusted, thoughtful, genuine partnerships with different colleagues in different asset classes about how to tackle investing in the future and the future that's changing. And so I basically say I want it to be a more profound than just like we have this sort of team that sits over there and knows a bit about climate. It's got to be more nuanced than that, which is, gosh, it's all about relationships and it's all about, shared incentives and it's all around shared education opportunities because, the team that I sit in, we don't have 30 years of private equity experience, whereas some of my colleagues do, but we do have a lot of climate and financial knowledge. And it's when the two come together in a way of sort of mutual understanding and respect that I think the magic, that sounds really cliched, that's when the magic can happen. And that's what we need to be humble enough to try and build together.
Speaking of the magic, yeah, I mean, like I'm looking forward to this case study.
It's going to be good.
Because it's like one of the things like that I, when I was poking around on your website, like I was really, pleasantly surprised to see affordable housing included in this, broader kind of sustainability, climate adaptation portfolio. And like, I guess, two-part question to some degree, like, does the discussion about climate crowd out some of these other kind of, huge wins? Like, I mean, California, do you guys have an affordable housing problem? I mean, you just bought a house, so.
Literally. Yeah. No, Sloan, you're absolutely right. And kind of, it's funny you asked that about is how does it crowd out? Because when we were thinking about, investing in solutions, sustainability solutions, where do we want to focus? I remember a couple of my team and I, we were sort of sitting down, we were mapping out this mega landscape of all the different opportunities that we could invest in. And there's water here and there's affordable housing here and there's this. And we sort of presented that to a couple of people internally and you could just see it was just too overwhelming and too like, whoa. So we're like, okay, back to basics. Let's start with climate solutions. Let's identify climate solutions. And we've got a sort of a nomenclature about that. And let's start with affordable housing because we have a real estate team that owns a number of kind of operators that has an understanding of affordable housing, that realizes the gap that exists. So rather than trying to say we're going to tackle income inequality through all of our impact, we're going to say, no, let's start with something that we know a little bit more, which is more tangible and we can get our heads around together. And let's say we're going to expand our investments in affordable housing. So that's what we've done. And with our real estate colleagues who are just fabulous to work with on this, that's something that they were going to be doing and focusing on, but we are bringing a kind of a combined shared energy to it that I think is really exciting. And we just did our first deal together in an affordable housing opportunity in South Central LA. Which is really focused on, underserved Black and brown communities with a huge community impact. So it feels like a really good place to start. So yeah.
And do you, I mean, look, we could talk to you forever about that and I know you got to go. But last quick question, like, do you guys on this unit invent new investment diligence requirements for these things? Like they may be more stringent, my guess is, because you're kind of looking at it from two angles now. But do you have the flexibility to think about, what should the diligence be and how should we be looking at this? Because I find many times public pension plans, this is kind of imposed on you from some, bureaucratic overlord.
No, I mean, it is. We do have some bureaucratic sort of processes that obviously we follow, but also, due process. But good question. I'll give you an example. We're running right now a search for a new public equity manager pool to help us diversify our public equity sustainability focused manager pool. And, the traditional route is, they have to be part of investment for us to be sort of in the mega search. And then we whittle that down through a kind of a due diligence questionnaire. We actually inserted a second stage in that, which was a set of questions that we sent to a sort of further shortlist around how do you integrate sustainability issues into the way that you invest, because we felt there was nothing we could get off the shelf or anything that they would provide us that would give us enough clarity on whether their understanding of sustainability as an alpha driver was aligned with ours. Because again, as we all know, there's, the SFDR and the EU and sort of others are trying to set up, and sorry, the Sustainable Finance Reporting Directive is trying to set up fund nomenclature around your sustainability fund or not, but it's really hard to know what you're buying off the shelf. So we developed our own set of questions, our own DDQ, specifically to sort of say, right, you're aligned with us or you're not. Now you make it into the smaller pool, and now this smaller pool, we're doing a traditional DDQ around, people, process, and everything else. So on that, we had to reinvent an entire level of kind of like filter to help us. On the private side, again, we are adding additional questions. We're adding additional kind of like expectations of sort of our external independent fiduciaries who help us to kind of assess whether the deals that we're looking at align with what we want to achieve.
We need to get, as you do those, I would love to help you get those case studies into the world, because it could be that you're a role model, right? Like part of the reason we do case studies is we want the world of institutional investors to copy you, and then they're investing in sustainable and on and on and on. So thank you for the work you're doing.
Happy to.
We're just so excited.
Oh, no, thank you. Well, yeah, honestly, I'd love to, to the extent where we want to share and learn, let me be quite clear. It's not just about sharing. It's about, we've got so much to continue to learn.
Yeah.
So to the extent we're able to do that, we want to be that team that's constantly curious.
Well, like I love a team that's constantly curious and, pushing public equity managers to do more real sustainability. I mean, like, there's a real leap of faith to be like, I'm gonna do like an out there lefty sustainability asset manager, and like the institutional supports and stuff like that are really not there to like, differentiate these things from, kind of like, here we are, we graduated from Harvard Business School 10 years ago, and it was the time of life that we, the stars were right that we should start a fund, So yeah, I mean, like that, I really look forward to these case studies and to having you back on at some point to discuss.
Thank you so much.
Thank you. Thank you very much. I really appreciate it.
All right. Good luck today.
Long distance high five. And yeah. Well, it's, I mean, like sometimes when we record these things, I'm like, how do we get to do this?
I know.
Like,
it's so fun. It's so
like,
fun. She's so fabulous.
And candid and informed and like, really thinking about this stuff, in a highly bureaucratic, highly like overseen situation, right? Where like, you think about, the big California plans, like, oh gosh, are those like, magnets for scrutiny? No.
Yeah. Yeah, but the cool thing there, she's like, yeah, we deployed capital into this, we're investing in that. Like there are things happening, and every single one of these are running through a return requirement of 7.5% or so, whatever the expected return target is, right? And so it'll be fabulous as these things mature to watch how those performance numbers track. So exciting times.
Yeah. Very exciting times. I have a brand new sound effect to share with you. Are you ready?
Hit me.
This is it's for building stuff is hard.
I love it. Is that a recording of me?
Yeah. I actually, Henry and Beatrice have actually been on, there are interns,
That's true.
Money now. They've been recording you grunting.
Yeah. Those crazy kids. Building stuff is
like,
hard. I have a thing.
Hard.
Which I'm prepared. which is also hard to prepare for the things that you're doing. I think
I'm
the thing
shaking my head.
that's hard is giving feedback. Not that I don't mind giving feedback. I don't want to ever kill somebody's momentum in the process of giving feedback. I think momentum is the currency upon which we build things. Like weight plus velocity, right? You want to add weight to things and you want to move faster. And when you give feedback, you're saying the weight of that is wrong or the speed is wrong, and you need to take a step back. And so finding ways to like get people to continue to feel the speed and the weight of what they're doing, but also change. I've been doing this for a long time, and I've been building so many different things that feedback is such an art. And, I jokingly say I use the shit sandwich approach, where you give a big compliment up front.
Classic.
Then you give the negative, and then you end with a big compliment. And I find that works. But for me, that's always a challenge. You have to give somebody feedback.
Yeah. I totally relate to that. I mean, I guess like, I'm in the like receiving feedback stage right now. And like it's really interesting because like there's like a subsection. I would say there's like, you get feedback where it's like, oh, you just kind of don't get it. Right. And that's fine. Like not everyone's going to get what's happening necessarily. But there really like, there's that kind of like, overlap of like, doesn't get it, but gets something else. And there's like a direct like applicability thing, where you can really just, like open a mind, change a decision, change a momentum.
I might change my answer, my question, my comment. Oh, you know what we're doing here? What are we doing? Comments, telling things.
Your observation.
I actually think it's even harder to find the good nugget in feedback. Because I also get feedback a lot. And so that's partly why I know it's so hard for people to give feedback, and they often suck at it. But and in the world of academia, where you're getting like peer review reports all the time, like half of them are baloney and they're like self-aggrandizing. And then half of those peer review reports are fabulous and really do improve your work. And so having like that fortitude to push past the emotion of being attacked and like use the good, like you're saying, like some part of it is good, to improve what you do. That is also very hard. It's all hard. This shit is just hard. That's why we have this segment on the podcast.
Yeah. I would say one of the things that I guess I've been an entrepreneur for a while, in various ways. Like I've been doing my consulting stuff, and what I was doing at CFAI was pretty entrepreneurial, but like actually starting and running a business, etc. It really has a way of making you much more intellectually at risk. Right. Like like that's kind of the benefit that I see to publishing and to podcasting and to getting thoughts out there all the time, is like you can kind of develop your thoughts and have people react to them. But yeah, it really is like putting yourself out there, holding the proverbial boombox over your head outside of the bedroom of your beloved at night, and totally. Just kind of like,
I know what you're doing. What's the song that he plays though? Say Anything is the movie. Isn't it really Say Anything, where he's holding the boombox and it's playing the amazing song outside?
I mean, maybe originally, but
Cusack.
It's such a Cusack. It is Cusack.
Oh yeah, the movie Say Anything. It's a fabulous movie.
And he's just like standing there miserably with a little box over his head.
But in your eyes, that's what's up. This is how we do it on the pod. I got it. Oh man, but now my mind's got. Oh, entrepreneurship and academia, I would argue, are fail fast machines. So they help you identify failures faster, and you learn from those failures, either in the form of feedback or reviews, or no's in the form of entrepreneurship. And I think that's like what makes those worlds special. But that implies that you have to be ready to fail and deal with the pain of it. Anywho.
Yeah. I mean, my thing, I guess, for this week is DNS systems.
Are you getting
Um,
attacked?
well, so I had a a thing, like I made a couple changes on the back end of Invest Vegan to kind of speed it up, etc. Um, and harden it against attack, because there are a lot of kind of older folks that kind of use the site, and I don't want to be man in the middle or whatever. But the thing that's been really interesting to me is like something magical happened, and I started getting like a couple inbound leads a day a little while ago. I don't know who or why necessarily, but it really is like kind of this crazy. It's like when you plant a seed and all of a sudden stuff starts happening, but it happens like totally outside of your control, and you just sort of have to observe as closely as you can. And I think that moving from the process of like where you have the spreadsheet and you have the the sketch of what you're doing, and you explain it to your friends, and they're like, that's not crazy actually. To like the point where you're like, oh crap, I need instrumentation to ask questions about what the hell is happening here. I don't have any of it. And it's like, and it's all like marketing instrumentation. It's not investment tooling. It's like, how are people behaving on the website?
Interesting.
And
this is why there should be like an opportunity for the asset owners to outperform, but they are just dysfunctional.
Mm-hmm.
You're having to spend a lot of money on like just understanding your clients. And this is this weird, strange world that we exist in, right? Where like the asset managers have to spend a lot of money to understand client needs, demands, objectives, in addition to the investment portfolio. Yeah, it's hard. I can only imagine what you're like having to design and build in order to manage all that.
Honestly, my number one tip for overcoming that is
I'm proud of you.
Thank you, my friend.
I had to do it. That wasn't saying anything moment. It was deep, and
that was very good.
The boombox.
Yep.
It is hard. I need to make light of what you're working on.
No. Honestly, my number one hack is dating a software engineer who knows a lot about the tooling.
That is good. Yeah. That was my hack in college. Marrying somebody smarter than me.
It really works.
Yeah.
I plan to use it. As much as possible. I mean, not in the some people might know I have Mormon heritage. I don't mean that I intend to start a large polygamous family.
You went there.
Anyway, time to move to the next section. Hey.
Man,
man,
I saw these questions earlier. There's a doozy. There's a doozy in here.
These are it's really like the cadence is just from chill to crazy. This is the Dear Ashby segment of the show. This for anyone who's maybe this is your first episode. This is where we answer questions from you. Specifically, Ashby answers questions from you, and then I opine if I have opines to opine.
Opinions, I believe they are called.
Opinions, and perhaps also
a kitty cat.
Sammy the cat will opine as well.
Sammy.
Yeah. She's a very, very, very personalitied cat. So first question is, what's your seed starting setup look like?
I mean, we just reuse all the little planter stuff that we get from the plant store and put seeds in those.
Yep.
In fact, I have like a little baby oak tree that was like literally out of an acorn that we shoved in there, and I can see it outside right now, and it's leafing. For like most of the winter, I thought it was dead. It's like, I'll just keep watering it. And then I often put those little planter things just out on the edge of the lawn so that I don't forget to water. The lawn gets watered 3 times a week. And also I just admit that like being in California, it's just so much easier. Like sometimes you can just like literally put seeds in the ground and forget about them and then be like, oh shit, that thing's growing.
Yeah, I do literally, I do often forget that you're in California.
So lucky compared to like people with frozen tundra, you know?
It's a great gardening hack.
Yeah, live in a
You
warm
know,
place.
yeah. This, seed starting though, pretty like it's not that hard to do if you happen to be in the tundra. You just get like that little $6.99 pallet from Home Depot.
Do you have a seed starting
Next
hack?
question.
I'm curious.
Ooh, oh yeah. Well, so what we did is, seeds. My number one seed starting hack is just order your damn seeds early because
have seeds. Is that hack?
have seeds.
Yeah.
Yeah, that's my main hack. Because like it's remarkably difficult actually to get good seeds in a timely fashion. More and more every year because people are getting into gardening. We're all thinking about our homes, the pandemic, etc. So I think that we had to order our seeds from like 5 different vendors. And some of them are taking 3+ weeks to ship. So yeah, but we have like a nice little IKEA shelf with some lights on top of it and a bunch of morning glories and snapdragons and cotton plants blooming that will kind of throw out into the frozen roof before too long. This question is like from a close listener of the fund.
Of the pod.
You mentioned of the pod.
Ooh.
That was a sound effect. That wasn't me just regularly farting. You mentioned your experience with the Russian Sovereign Wealth Fund in an earlier pod. If you are working on a new and similar project for a country like Iran, say, that may become hostile to the West in the future, what changes would you make based on that experience?
I'll start this by saying I just love our listeners. That is a fabulous question, right? Like
I know,
I
right?
saw that come in and I was like, God dang, like there's some pretty freaking like with it human beings listen. It's a good job you out there that ask me the tough question. Because then I have to sit down.
That's praxis
like,
right there.
I owe our community a response because, did I help? Have I been helping the bad guys? Some context on the project that occurred with the Russian direct investment fund. So I was never paid by them, right? Like I have helped to build a not-for-profit in Canada called the Institutional Investors Roundtable that works on behalf of the asset owners, Canada Pension Plan, Ontario Teachers, GIC, et cetera, et cetera. Got about $15 trillion of capital around the table. And our goal has been to find novel access points to avoid the cost of private equity. Have you heard me talk before? That's what I do. I try to get around the fee structures. And so this was 2012, 2013. This is before the invasion of Crimea, I believe. Was that 2014? Yep. Crimea? And RDIF, even before it was called RDIF, was a member in the IIR. And so they, again, it was a not-for-profit. So I was never paid by them. And in this case, I have to say the idea of building a platform to facilitate development and explicitly, which the RDIF was about, was deepening relationships across borders. So helping overseas investors get access into the Russian context. And oh, by the way, the model of the RDIF has been replicated in India with the NIIF, Turkey, now in Indonesia. You can almost argue some of the French stuff is very similar. And so from me looking at it, now I'm going to reveal some of my more, call it, dare I say, conservative thinking. If we can build economic links across these countries, then ideally we create higher cost of conflict because of the economic links, right? And that I would have hoped and did hope and explicitly thought would have reduced geopolitical risk, because the international reliance on Russia and Russia's reliance on the international community for investment capital, et cetera, would have kind of increased that cost. What I think is harder to see is like, he just didn't, Putin just didn't care, like he sees this as a purge of all the bad guys. And so then the question is, have I taken anything away from this? Would I go and do work with Iran? And I love that question because Iran, on the one hand, is a democracy in the Middle East. There's like some would say that the people are, aside from like the government there, pretty progressive, and that, if we could build more economic links between Iran and the West, maybe it would minimize the chance of a nuclear war or them doing something stupid like bombing Israel. I think the real fear I have is when people are isolated behind a curtain, dare I say, an iron curtain, and don't feel like there are costs associated with doing something really bellicose. Yeah. So would I do it? I don't think I would. I think my wife would probably, as a Canadian, my Canadian passport can get me into Iran. I'm not that worried about it, but I don't have plans to do it. That's my wife would be like, what the hell are you doing? But I think part of me just sees these like international projects as like reducing the geopolitical risk than increasing it. I don't know. I'm happy to like take critiques and feedback on that. But what do you think?
I mean, I would, I think that this is one of those like classic benchmarking things where it's like, what shows up on the benchmark right now is at time T, right? Like, whatever it was 3 weeks ago, some people were invested in Russia.
Yeah.
But what doesn't show up in the benchmarking is that like McDonald's opened in Russia in the 90s and like, greatly increased, cultural linkages between these two countries that were like literally on the brink of blowing up the world for a very long time.
Yeah.
And like created all kinds of jobs, created all kinds of prosperity. So like, I think you kind of have to like, I mean, it's an absurd exercise to try and do, but from a theoretical perspective, you could go and say, all right, so, what are the I guess in healthcare interventions, they think in terms of QALYs, like quality adjusted human life years, that are, made by like funding a bunch of malaria nets, right? And you could kind of, if you were, say, the Gates Foundation, you could denominate your humanitarian interventions in terms of the number of quality adjusted life years that you could buy by funding them in various different places. This is kind of a digression, I'm realizing, but
run with it. Yeah.
Yeah. So, but like, so let's say like, we start with
taking the heat off of
like,
me. I'm loving it.
Yeah, exactly. So like, who wants to talk about a really, a relatively obscure concept in development economics?
Yeah.
But like, so I would argue that, giving people jobs and things to do and creating like uses for capital domestically, as a substantial boost to quality adjusted human life years. On the flip side, like, having anything to do with Russia, arguably, has a negative effect on the number of quality adjusted human life years, given that they're engaged in a war of aggression and choice at the moment. And, every dollar that went into the country and circulated domestically and was saved and invested and taxed, could theoretically be argued, had directed a modicum of funding towards that. But like, I think that you have to think about it in terms of the veil of ignorance that we operate in as investors. And it's like a John Stuart Mill, like ethical concept that I don't see people talk about enough in like capital markets, right?
Yeah.
Yeah. Like because like, I mean, you can't know what's going to happen 25 years from now, or 10 years from now, or 3 years from now. You can just kind of do your best and try to build bridges, so and
you can be open to the critique. I mean, the thing that's so interesting about this moment, this question, which I truly loved, because it forced me to be like, what would I do? One, I don't think I would accept payment from a bad acting country for this. I think that just feels bad. But I also think I would help them implement good governance to avoid graft. And I've done that. I mean, I won't mention the country in the middle, in the middle of Asia that I went to, because I don't want to get in trouble. But like, there were accusations that the subsoil assets in that country were being pilfered. And by showing up and showing them like how to design a fiscal rule and how to design like a professional investment program, how to oversee that with proper governance and accountability. Like, ideally, you are helping avoid the corruption in certain places.
Yeah.
By bringing good governance to them. And doesn't that then put them on a trajectory to maybe not being as corrupt? It's very hard.
Well, and then you get into like the trolley problem of like, okay, so you see this thing happening, enough about sovereign wealth funds that a disaster is plausible, right? Like no matter
you've
what
seen
happens,
one MVP, right?
Yeah.
You've seen the movie on Netflix about it. Like these things happen if they have bad governance, and Goldman Sachs help them do that.
Yeah, exactly. And like, and they'll call up, like some reputable seeming Western firm and whatever. And like, and then maybe they'll put up the Ashby Monk bat signal. And if you don't respond to that, do you have an ethical,
First of all,
there?
Can we invent that? The bat signal.
The Ashby Monk bat signal.
What is it? Is it like the giant boofy hair like shot up into the cloud? I just like I'm now picturing like what is my equivalent.
I mean, I think it's like when any government anywhere issues a press release, it's like, we're starting a new inward focused development.
True. Yeah. We're building a sovereign development fund to attract foreign capital.
Yes.
It's like, they just turned on a light and the bat is up on the clouds.
Yeah.
Ashby shows
Yeah,
up
like
with his deep voice. Hello.
Yeah, exactly.
Good governance pays off.
Hello, people of Turkmenistan.
Hey, what's
all right.
next? I think I did
Last question. Assuming disclosure and governance are managed appropriately, what percentage of a long-term investment, 30-plus year horizon portfolio should be invested in private assets?
Okay. So I love the last question. This question, dear listener, I'm going to edit a little bit, okay? Even though I love it, which I do. But dear listener, I don't think the question should be disclosure, governance, and private assets. I think it should be assuming you understand the liquidity profile. So like when I need to get cash out of this fund.
Yep.
And how much should be invested in equity risk. Because like we now know the continuum from private to public has just dramatically changed. And as new marketplaces emerge, like the ability to get access to, say, private equities is much different than it was even 7 years ago. And so with your permission, Sloan, I would say, how much of a fund should we invest that has a 30-year kind of like capital accumulation phase where we don't need to take cash out? And how much should we be putting in equity risk? And I would say almost 80% would be in equity risk. Now, if we're doing like the traditional product buckets, I think people would say private, in my mind, means more liquidity risk, which is a way to boost returns, or at least used to be. I would say, again, if you have a 30-year time horizon, you can just fill your boots with this stuff, right? Like, you want to be able to model your cash flows to make sure you're able to meet a drawdown and meet your pacing commitments. Remember, putting money into private markets means you have a 5-year drawdown period where capital is being called. So you need to have pretty good systems in place to manage that effectively. All that being said, you could put huge amounts into these private markets. And I think a long-term investor that works wonders because it ties you to the mast, so to speak, and forces you to think long-term. Anyway, so I'm mixing and matching here my responses, but I would say take a ton of equity risk, take as much illiquidity, private market, investing as you want, but model it very effectively so you never miss a capital call. And I think that would be a way to maximize returns. Does that make sense?
Yeah, that makes a lot of sense.
Okay.
Yeah. And like, I think that, the distinction that you're drawing between equity risk and like, say, credit risk and liquidity risk in assessing these sorts of things is not a subtle point, from a practical standpoint, right? Like because like the way that we're used to thinking about it in these product buckets that you talked about is like, okay, well, there's like the expensive, super fee paying portion of the portfolio that like, the ghost of David Swenson at Yale like will haunt you if you have less than 40% of your long term portfolio in privates. But is that private credit? Like, are you lending money to consumers? Are you lending money to growth companies? Are you or are you investing in climate solutions directly? Those are all private, and they all have such different risk profiles. Almost like the private markets have a vast spectrum of things inside of them.
Yes, it's almost as if like categories like that aren't that useful.
It's almost like we need to queer the boundaries between these accepted buckets. So yeah, we're running a little long, so let's cut to the garden tip. Yeah, so the accent that
It's actually
I mean, let's that like I think we promised the listeners some accents at the top of it, and what we gave them is John Malkovich.
Is that Peter Gabriel?
That is Peter Gabriel, yeah. But it's not John Malkovich; it's John
Cusack.
Cusack.
It's John Cusack.
I always confuse those two guys.
Are you going to try a Chicago accent now?
Oh no, I can't.
You?
I feel like a Malkovich impression is like a really good impression to have, though.
Have you seen Space Force?
Yeah,
I mean,
very good.
It is
very good,
unbelievably good television. I mean, we binged it, my family. The next season came out, and we was like, gone. What, the 2 days done?
Yep.
Anyway, there's your tip. That's not a gardening tip. That's a tip.
It's just a tip. Yeah, you got to get on that Space Force. Yeah, I mean, like, aside from order seeds, I'm gonna go with, think about like, I mean, I guess if you use potting soil, if you grow in containers, you should be aware that peat moss, which is one of the most common ingredients in gardening soil, is not sustainable at all.
Interesting. Peat moss is a carbon emitter.
Yeah, so peat bogs are one of the most potent carbon sinks that are naturally occurring.
Oh, yeah. So shouldn't be pulling out of there.
Exactly. Yeah. So when we, I mean, there's no way to get peat moss out of a peat bog other than like literally strip mining it. Where you like cut it up into little blocks and like pick it up and move it. So like in the US, we have an easier time with this because our peat industry is our peat imports usually come from Canada, which is a newer industry, and less of the peat bogs have been harvested. But in the UK and and all sorts of other places, they're already enacting legislation to make using peat moss in your gardening soil illegal. Yeah, so hobbyists in the UK won't be able to use it after 2024, I think, and professional horticulturalists won't be able to use it after 2030 in the UK. So if you're trying to move away from it, it's not a chill process.
Really?
It's not simple. I mean, because like, sphagnum moss, which is like the main ingredient in peat moss, is like just a perfect ingredient for, cultivating anything in all sorts of environments, right? It retains moisture well, it retains nutrition well. It's just great. And it's relatively inexpensive too.
Wow.
Because we don't really tax the externalities. So my tip would be like right now I'm going through the experiments I did last year to try and get off of peat moss. And I did all kinds of crazy shit.
Go on.
Like I tried growing plants in pots that were just coco coir, for instance. And that is dumb.
Heard it here first.
Yeah. So basically my tip is like take seriously getting off of this stuff as you're buying peat moss, but don't just jump, from one thing to another because it will be very, very discouraging. So take the time to, I mean, if you're listening to this podcast, the odds are that you can afford to spend $35 on various, different kinds of soil amendments. So when you go to the garden center, look around, buy 5 different things that don't have peat moss in, and try try them.
Beautiful.
Because by 2025 you probably should not be using it. So I guess, maybe we could get people to make the peat free by 2025 pledge as a compliment to the net zero by 2050.
We got to get the word bog in our slogan somehow. Your bogs will thank you, or Barney the
instead
bog.
of getting bogged down,
Bog.
yeah, let's get bogged up instead of bogged down, right?
Well done. My gardening tip is much more high level, and in a small way, you may suspect I forgot. Mine, just before the pod, though, I went out. My jasmine is blooming. Okay. And it's here. It's almost April. We're in March, April here. Things are blooming all over this yard. And I was just going to tell everybody, like, this is the moment that, like, we do all this for. So, like, make sure you stop and smell the stuff. I was just transported to, like, 7-year-old Ashby, like, just before this.
Aww.
By smelling that jasmine. I was like, you know how smells trigger all the... I was like, oh my God, I can remember being a kid smelling this.
You're just
smell.
You're transported. It's like, I'm picturing like 7-year-old Ashby still with the same amount of crazy hair.
Talking about pension
yeah, exactly. Just like, that jasmine smells like it's got a great governance structure in place.
Jasmine is so good. I mean, when you smell jasmine that's blooming, it's like, holy fiat. I know why they made soap out of this stuff. It is fabulous.
Yeah, that's like,
anyway.
I mean, if only I could get soap that smells like my compost, which is truly the best smell.
Beautiful. On that note,
all right,
we love you.
Bye.
Bye.
You all. Bye.
Make it rain on them.